Hey guys, today we want to talk about margin. This is an important topic for us, and the avid trader is used to it. So we need to explain to you what is margin and what is important to know when you're trading on margin. So first of all, there are two kinds of trading. You can open a long trade. That means you buy something first, you wait for it to increase its value and sell it later. So you gain. This is a classic long trade. And if you're opening a long trade, you have to pay something, of course. And this is your maximum risk because what you paid first when opening the position is what you can lose if things go really bad and your market expectations are not met. So there are always two kind of actions required, buying and selling. But it's important to know that the order of these two actions is at your choice. So what you also could do is sell something first and buy it back later. This is also possible at the stock exchanges. So let's have a look what happens when you're opening a short trade. So that means you sell something first. If you do that, you don't have to pay anything. It's the opposite way. You gain something. You get a premium for opening this position. This is a really good thing. But remember, two kind of actions required. So if you sell something first, you need to buy it back later. Okay, so you got a premium. And what is your market expectations at this point? If you're opening a long trade, you want the underlying to rise and you want your option price to rise. So you can sell it for more money than you paid at the beginning. If you're opening a short trade and you got a premium, what you want and what you expect is the underlying and the option price as well to decrease. Because if you got a premium, let's say $10 when opening the position, and you know that you have to buy it back later, it would be wonderful if at the point where you want to buy it back, the value of your option is only $4 because you got 10 at the beginning, and if you buy it back for 4, you have a gain of $6. Wonderful. The optimum case would be if the value of your asset you sold would be 0 at the end. This would be wonderful because then you wouldn't have to pay anything to close this position you opened first. So in this case, the optimum case, you got $10 as a premium and you have to pay $0 to close. So the $10 are yours, totally yours. So if it would be that simple, that would mean you could open any short position, 10 short positions, 100 short positions, and always get a premium, get money, and everything will be fine. But unfortunately, it's not like that. Because remember, you have a market expectation by opening a position. So there are two possibilities. First, you are right. Then the value of your underlying and of your option trade you sold is decreasing to nothingness, is 0, you don't have to buy it back. Wonderful. Second, you are not right. So what you expected from this underlying and this option is not coming true. That would mean the underlying and the option price would rise. It would increase after opening the position. This would be really bad because you got just $10 premium by opening the position. And now let's say the option price is $40. This would mean you lose $30. So this is not much. Of course, you have $30 and you could pay these losses. But let's say you open 10 or 100 contracts of this trade, then the losses would be very high. And maybe some people would open a lot of short positions and were unable to cover these losses. The broker has to make sure that you have always enough money to cover your potential losses. So this is the point where margin becomes important. Because the broker does not allow everybody to open these short positions. The broker checks if you have enough free capital in your account. And this is margin. Have a look at this. This is an order preview. If you open a short position, you always get an order preview at the trader workstation. And there you can see how much margin is required to open this trade and to hold it afterwards. So, have a look at this. Initial margin. This means you have to have free capital, free money, free cash in your account of at least 2,580. If you have less, you are not allowed to open this position. So there is a maintenance margin too. That means if you open the position, your free cash in your account has to be at least 1,779. Always. You always have to have this at minimum, otherwise you are not allowed to hold this position further. Then the broker would decide to remember you, pay more cash into your account, or we will close this position. So this is important to know, because if you open a position, a long trade, you have at the maximum risk is what you paid. But what is your risk if you're opening a short position? In our example, the option price was rising up to $40, but it could be worse. It could rise to $100 or $1,000. Nobody knows. So your losses would be very, very high. The broker has to protect itself, and it has to protect you by going bankrupt, you know? So the margin is important for this. But you don't have to worry about this topic, because we always opened safety trades. We are Allied Option Trading Group, and we are opening safe trades only. And safety is our top priority. So if we recommend a trade, we have a look at this margin topic. And you should have a look at this margin topic. You should have a look at this preview of your order, and then you decide how many contracts you order, how much margin is required. Just have a look at your free cash flow in your account and compare it, and then you can make a decision about this. So, as I said before, don't worry, we are safety traders. You have to know what margin is, but you don't have to worry about it. Okay, guys, thank you for listening. See you later. Goodbye.